And the young lady that was hung, that found behind the house in Mississippi, this is getting a bit much now. It's getting a bit much. And after a while, it's like, yo, as they said, a rat is not really a strong animal. But if you put a rat in a corner, that could be one of the most deadliest animals if you put that rat in a corner. And I'm not calling anyone a rat. I'm not, especially not people who look like me in my respective community. But you are pushing people based upon what's going on because they're getting stressed mentally, they're getting stressed from their finances. Some of them who are not keeping themselves abreast and at least continue their education, they feel like they're falling behind. Look, we don't need no, we already at a tipping point. Let's recognize and be responsible enough to be like, hey, chill. Let's get better. So with the monologue complete, let us get into the teaching today, as we're going to be dealing with central banks. How are we doing, Ms. Johnson?
We are clear.
Excellent. So, as we get into today's teaching, central banks is not just a United States thing. Every single country, if they have an economy, they have a central bank. If they have currency, they have a central bank. They have, if they're dealing with anything that's dealing with import export, they have a central bank. So central bank is not a United States thing. Remember, there were banks. Remember, the United States just celebrated 250 years of existence. There have been central banks and banking systems as we went through some of the previous episodes, which you can go on the YouTube channel at Dr. Gregory Clarke Master Coach, or just type in my name, Gregory Clarke D. Min, and you can catch up on that when we dealt with from barter to, banking. From the barter systems to all the way now. So banking systems or central banks or some sort of facility that's allowing for the trust factors to work have been around way before the United States. So understanding the institutions at the heart of every modern economy. The key takeaways that we desire for you to get tonight is monetary policy. Central banks manage monetary policy, money and credit conditions, and financial system stability. It's very important to recognize that. Next one, interest rates and securities. They influence borrowing and spending primarily through interest rates and securities transactions. That's why when you hear about the Fed funds rate, did they hold, did they cut the rate, stuff like that, that affects your credit cards, affects your mortgages, affects a whole bunch of things. So let's just keep that in our frontal lobe. Bank regulation. They regulate banks through capital, liquidity reserve, and consumer protection rules. Usually when you hear the Fed funds rate, that is the rate that they share, or that banks go to the Fed here in the United States, go to our central bank, which is the Federal Reserve, to get money from or to borrow money so they can lend out. That's why if you have a credit card that has 28% interest, 30% interest, the banks love you. Because even if you're paying down the debt, if they already have you at those particular number percentages, forget about it. Unless you have a real plan of nullifying and getting into that principal, they're making money. Payment services. They provide payment and settlement services that help money move safely through the financial system. All the back channels, all the modern conveniences that we have were all started through how most central banks can see how they can make sure that money can run through the system appropriately and quickly without any stopgaps. And crisis backup. In crises, they can lend to solvent but illiquid institutions to contain bank runs and widen distribution. And why is that so important as well? Because like in the 90s, we had something called the S&L crisis with savings and loans, where there were a bunch of regional banks that started going under because they were financing a lot of debt securities or derivatives and certain things and junk bonds and that whole Michael Milken stuff. This is stuff that you should do your research on or give yourself the ability to be abreast about. Because as we can tell, having access to credit is a good thing. Utilizing it properly is the difference. So when people start to say, oh, no, I don't want any credit, that's not good, right? But first off, you said the word want. So that's the first thing you went off on. And credit is good, utilized properly. And like with anything, if it's misused, then that's where things can go a little funky. So as we go through this, these are the key takeaways that I'm desiring for you to get today as we share this. What is a central bank? Ms. Johnson, can you read that paragraph for me, please?
A central bank is the public institution at the core of a country's monetary and financial system. Its core job is to manage the money supply and monetary policy, issue currency or oversee its issuance, regulate the banking system, and work to preserve financial stability.
Now, as you can tell by the image to the right, looks like a nice vault, but if any of us had the opportunity to have that type of access in that type of room, you'd be sitting there smiling from ear to ear. Be like a pig in slop. Be like Dr. Cheryl and ice cream. It'd be, a happy day. But you start to recognize the ability to manage the money supply. And like we probably stated, if it wasn't last week, it was definitely the week before last when we started to talk about. Once we got off of the gold standard where our finances or our currency was backed by something tangible, they gave our central bank, which is called the Federal Reserve here in the United States, carte blanche to start printing money. And the United States, as a government, borrows money from the Federal Reserve. So when you hear numbers like $40 trillion, like who do they owe $40 trillion to? Well, not only do they owe the federal bank, which they have to pay down on their debt, which something like that, 40 trillion. That means, I think it broke down last week when I saw it on CNBC. I believe right now, the federal government's budget, 19% of it is just to pay down debt. That's not to help people. That means 19% of the taxes and all the stuff that they collect goes right back on just to pay down on debt. I want you to think about that. That's a major piece. And the administration and the individuals and people who attempt to get certain things, everyone is using credit. It's like when they talked about the Los Angeles Lakers barely last year were sold for $10 billion. Now the gentleman and Kushner, Bob Iger and Kushner now are buying the Lakers for $12.5 billion. Do you think they had $12.5 billion in cash just laying around? No. If I'm not mistaken, they said probably about 15% of that purchase price in tangible resources and equity. The rest are going to borrow. And why would banks do that? Because that's what a bank does. You think a bank is there for you to put money into it, and they think that no, the banks desire your money. So when they see that you have $10,000 in your account, they know that, okay, this person has $10,000 in a particular account in one of our branches. Okay, we're going to lend that $10,000 out to some company or some individual or some mortgage. And as they pay back that money, we're going to stay solvent. And that money that we make in the middle is our money because we're using the resources as leverage to lend out. And hopefully we lend out to the right people. And if we keep generating the return on interest and return on principal, we start to own much more stuff. And then we become investors in a whole bunch of other stuff. So any thoughts about a central bank before we move forward? Anything that's coming to mind, any questions, anything that may be coming to mind that you may not have realized or understood, it's a great opportunity to ask your question if you have one. Okay. So make sure I'm clear. So remember, if there's any questions, please raise your hand or interject powerfully if you need to. So how do central banks influence the economy? Monetary policy tools. Central banks use monetary policy to affect the availability and price of money and credit. Before I continue on in my statement, that means when you hear about the Fed funds rate and they say it's getting higher or lower, if they raise rates, that means your credit card rates, that means your mortgage rates, depending percentage it costs you to get credit or even to get some sort of financing, everything goes up. When they cut rates, because especially if inflation is low, they're trying to make it more easier for people to get access to dollars. So they'll cut the rates because right now the economy could be doing in a positive direction and they desire to stimulate the rates. Right now, our economy is to crap. Between the high gas prices, high grocery prices, all the instability, the markets don't like instability. There'll be some days where the market can go up 200-300 points, and all of a sudden the next day it drops 500 points, and you're sitting there like, you're looking at your portfolio like, okay, there's some movement, but it's helter-skelter. It's very skullduggery. Because it's like, wait a minute, it's like this permanent 6-7 game that's out of fad. What are we doing here? What are you doing? So raising policy interest rates generally makes borrowing more expensive, tending to curb spending and inflation. Lowering rates reduces borrowing costs, as I just stated, encouraging loans, spending, and investment. Even people who invest in the markets, and sometimes you hear people talk about margins. Those are loans. Usually a bank, depending upon your level of investment, they'll lend you money. The investment bank will lend you money, and they'll say, you know, what you want to do with it? Are you going to circulate it and buy things? Like, nah, I'm going to buy some more securities. I'm going to use your money to purchase some more stuff, hoping that stuff goes up. And if it does go up, it means I borrowed money, which I eventually have to pay back, but it's backed by something tangible. That's margins. So as we continue on, their usual macroeconomic goals are stable prices, sustainable employment or growth, and moderate long-term rates through exact mandates differ across countries. And that's why I said central banks are respective to their respective country. You have some countries where everything is out of whack, or the monetary system is still beholden to others, beholden to the World Bank, and they owe money to, those banks that are global. The economies, they're beholden to that. So that means they could be paying more debt down or paying down their debt, which is going to cost their people more money, which means the stuff that's going to come to them is going to cost more dollars for them to utilize, or more currency for them to utilize to get the same thing. And so we should always be aware of these policy tools. They also conduct open market operations, buying or selling government securities, like the Federal Reserve here in the United States. They buy what they call treasuries, which is investments, which pretty much they're saying that this private corporation is literally buying these treasury notes to make interest off the government, because the government wants to do stuff, do business, buy things for the government to run. And every so often, the government has to pay back the interest on these loans, on these securities. It's very simple. But with the people that are in office right now, they don't act like regular Republicans who claim to like less government, less spending, less borrowing, all those things as usually Republican tenets. They just keep swiping the card. Who's going to pay for it? Somebody's going to pay for it. It may not be me, but I keep swiping. So purchases add cash and reserves to the banking system and tend to ease financial conditions. Sales remove cash and tend to tighten them. Central banks can also influence the supply of credit through reserve requirements, discount window lending, and during severe stress, large-scale asset purchases known as quantitative easing. Now, when they do stuff like this, that's what happened in 2008 when Barack Obama became the 44th president. He inherited a mess. That's why when certain times and certain people talk about his presidency and says he ain't do a lot of stuff for black people, look, those first 4 years, he was cleaning up hot mess. It was a hot mess. We were in a war that we should not have been. We were fighting against people. We were circulating. There were dollars that was going out the window. And then the stock market was not only crashing, then you had the housing market crash. He had to work with the central bank to start to prop up the markets because at one point they thought that Detroit was going to close. We was going to no longer have an auto industry that was going to be based out of the United States. That's how bad it was in 2008. And it took almost the first 4 years, his first part of his first half of his presidency, just to clean up stuff. And during that time to get, the Affordable Care Act through as well, to finally get through so Americans can have some access of healthcare like the other industrialized nations that we claim to be better than. So central banks have a lot of power behind the scenes. So sometimes people say, oh, my credit card bill went up. Yeah, you need to check that. That's why you need to look at your statements. You need to be aware of your spending or your circulation. Because not that the credit is bad. What are you buying? What are you circulating? Are you moving towards asset accumulation, which is a good thing because that's what everyone else is doing? Or are you just attempting to look good just to pacify yourself, which doesn't work? Any thoughts before we move on? Any questions before we move on? Excellent. How they regulate banks and maintain stability. Supervisory toolkit. Ms. Johnson, could you read that paragraph on the supervisory toolkit?
A central bank supervises banks to reduce the risk that weakness at one institution spread through the system. Its regulatory toolkit can include capital and reserve requirements, liquidity standards, prudential limits on risk-taking, examinations, audits, enforcement actions, and consumer protection rules. Regulation operates both at the individual bank level, microprudential, and system-wide level, macroprudential.
Now, that's one of the things that's so important. Thank you for that, Ms. Johnson. And Dr. Clarke, I'm going to ask you to read the second paragraph, but not yet. The reason why you need someone to monitor the banks, it's not that we know what a bank does. Anyone who has any just basic space understand what a bank does. A bank is there to make money based upon the fact of the deposits that they have. They turn around and leverage. It's all about leverage. You take those deposits, and that money's not just sitting there looking at them. They're taking it out and finding opportunities for people who they feel who are qualified that need financing so they can make money on the interest. That's just the basic tenet of a bank or credit union or stuff like that. Any type of financial institution. If it's a financial institution, they start saying, oh, we'll offer you this or we'll offer you a credit card. There's a reason why they're doing that. They're willing to extend you something. So as you utilize it and you pay it back, they make money. Very simple exercise. It's really not that hard. But it gets compounded because of the fact of the lack of transparency in the way that financial literacy is not necessarily shared. Then people start to see, like when Dr. Cheryl gave us that great story, which she wasn't the only one that experienced that, how it was pretty much predatory lending. And they really do that, sometimes a lot of these schools to get you integrated into the system. And then once you get integrated, and then if you don't become a wise steward over your money, then you can fall behind. So the lender of last resort. This is where it gets very, very funny. And this is like what happened in 2008, in 1990s when the Federal Reserve had stepped in during the savings and loan crisis of the 90s, 2008, when the housing market crashed and investment banks like Lehman Brothers or Bear Stearns, who are no longer in existence, started failing, and you had insurance companies that couldn't cover all the stuff because the money was just running rampant. So, Dr. Cheryl, can you read that paragraph for us, please?
Sure. The second one?
Yeah, the second one.
Central banks also serve as lenders of last resort. When an otherwise visible bank faces a short-term liquidity shortage, and I don't have my glasses on, and cannot obtain marketing funding, emergency central bank credit can help it meet withdrawals and obligation. This function can reduce the risk of a panic-driven bank run and what's that? Contagion, though it creates a trade-off. Ready access to support can encourage excessive risk taking if poorly controlled.
Thank you. So what happens is that it's like with anyone. Sometimes people will have, say, a $10,000 credit card, and they use it up. And then all of a sudden, you start going to the bank and saying, well, I don't have the money to stand a third. Maybe I might file bankruptcy to stand a third. And they all say, oh, we don't want you to do that. Because that means they're about to take a loss. Because they're not going to get paid. They're going to have to write that off the books, even though it will impact your credit. I'm talking it from the standpoint here in the United States. But what they do for banks, when banks are, not being run correctly, or they haven't been wise with their decision making on what they've lent out, the Federal Reserve can come back. Our central bank will come in and say, okay, we're pretty much coming in, as Dr. Sher was alluding to about that shirt. We're coming in now because we see that the baby needs a babysitter. And since the babysitter is not doing what they're supposed to do, too big to fail, exactly. And there were certain banks, just like they noticed in 2008, it was like a GM, a Chrysler, and all of a sudden we no longer have an auto industry. It was like what federal government pretty much did was they actually had to pour billions upon billions of dollars into the auto industry. But it wasn't a long-term investment. It was basically, okay, we're lending you this money. We're going to make some money off of you as you get your stuff together, and then we're out. We decide to get our money back, and now once we get our money back, that means whatever you have, keep working the principles and doing everything foundationally that works so you can have a viable business. So usually when you hear like a central bank has to go take over some sort of bank in a respective country, you already know somebody's been dipping their hand into the cookie jar too much, because there's no reason why it's being poorly ran. But if it is being poorly ran, that means it's usually some sort of embezzlement, some sort of maybe risky bad moves, which is still bad because that means you weren't prudent with the resources that you had to make sure that you get a return back. So, those thoughts do come into play. As we go on to the next slide. Their operational role in the financial system. Payments infrastructure. The U.S. Federal Reserve operates wholesale payment services that move funds and securities between banks, while Regulation J establishes rules for check collection and Fed wire transfers, supporting secure, timely settlement. Foreign exchange management. Central banks manage foreign exchange reserves and may intervene in currency markets to limit disruptive exchange rate volatility. Now, that is very far before I go to the third one. That one is very important. It's like what's going on now with the craziness that's happening between the U.S. and Canada. Canada didn't start this. We did. And it's already bad enough that Canadians already know that their currency is probably maybe 60 to 70% of the American dollar. So that means it costs them more to get an American dollar. So now with the tariffs on certain items that they're used to getting us from the United States, it's going to cost them more because now the import charges, which Canada's government is enacting based upon what the craziness we did here in the United States, no one wins. That means it's more expensive for the Canadians. It's going to be more expensive for the Americans. And then all of a sudden we find out sometime in 2027, all of a sudden, okay, this was illegal and we need to start returns. Then why did we do this? Why did we do this? So forward guidance and communication. They use policy statements and forward guidance to shape households, businesses, and market expectations, influencing financial conditions even before a formal policy change has fully worked through the economy. I know like every month or every 2 months, you'll hear that here in the United States that the Federal Reserve will have their major meeting because they're looking at the economic data. They're looking to see where inflation is. They're looking to see what's the sentiment out there because also the markets are part psychological. They're looking to see all these things and say, okay, does it feel like a great condition or is it a bad condition? If it's a bad condition, either we're going to have to raise the rates or we're going to keep the money, the Fed funds rate at that particular level so that we don't really disrupt the craziness. Or if things are getting better, okay, maybe we can ease. Maybe we may lower the rate, which will make it easier for people to borrow. And if they're being wise in their borrowing, maybe they're going to create more jobs, hire more people, or create more opportunities that can help stimulate the economy. So it helps in the long run. So as you can tell by all of the particular things that keep happening here in this country right now, that's not the case. So our financial system is still working properly, but it always is based upon, do we have a wise steward at the helm? If we have a wise steward, there's a high probability there's going to be prosperity that'll trickle down to everybody. When you don't have a wise steward, you have a bunch of people at the top who keep becoming empowered and financially adept, and we're seeing people becoming trillionaires and stuff like that, but it doesn't trickle down to everyone else, which doesn't work for even though capitalism has a space to work, but it still needs some level of balance, or it's not going to be good for the long term. Let's move on to the next slide. So in summary, number one, it's a policy setter, influences rates and credit availability across the economy. That's what a central bank does. It sets policy. Dr. Shaw, can you read number two for me? Bank supervisor.
Ensures resiliency of individual banks and other wider systems.
So since their central bank is the bank supervisor, they're making sure that all the other banks that's within that particular confines or responsibility that they cover, that they're doing what they're supposed to do. Because if everyone's doing their job and we're supervising you correctly, that means the system is not going to get broken down. Ms. Johnson, can you read number three, payments operator?
Runs infrastructure for safe, timely financial settlement.
Yeah, you don't want something that's going to where people can't see their finances. Like back in the day, it used to be like, oh, you have to wait 7 days or 5 days for a check to clear. And then when things started getting much more technologically advanced, all of a sudden it's like, especially if you get a check and it's within that same bank, especially like say if you have Chase here in the United States and you get a check from someone gives you a check, you still receive a check, but if you get a check and it's from Chase, forget about it. You deposit that, you should see those finances the next day. Because even within that respective banking system, even though it's part of the overall bigger system, that chase to chase, when they can see that real, oh, you see the fund, oh, just debit that account, add that account over, add those funds to this account over here. It's all a press of a button. And number 4 is crisis backstop. It preserves confidence in the currency and financial system. That's why you hear a lot about, making sure that the dollar is still respected, that it doesn't feel like it's devaluing. And that's why inflation hurts the dollar, because that same dollar that you can have that same dollar from 20 years ago. That dollar 20 years ago can buy you much more than it can buy you right now. The same way that we would hear, like, those are probably from the silent generation of baby boomers. Said, I remember if I had $1, that would buy me, like a gallon of milk and this, and they can go through all this stuff that a dollar would be able to circulate. Right now, that dollar wouldn't even buy a quart of milk. So central banks function as a financial systems policy setter, its bank supervisor, its payment operator, and crisis backstop. Their actions influence the rates the banks can charge, how readily credit flows, and the resilience of banks and payment networks, and the confidence in the currency and the financial system. Remember, everything goes back to trust. If you trust that that dollar is worth, that dollar or that $20 bill or that 50 or that 100 is worth what it's worth, then that means you have some sort of trust in the system. So you're going to keep, the revolving door keeps opening. And so that gives us a greater understanding about what a central bank does, even though you probably never be able to step into a central bank. And the reflection. Personal impact, number 1. How do central bank decisions affect your everyday life? They affect your life, your borrowing rates, depending upon where your credit score is, especially for those of you in the United States. That's an emphasis point of, what type of actual interest rate that you'll get. You're saving. When people say that, they put in a money market account or whatever. Money market account means that you're getting some interest. Most times, interest is nothing to be desired because it's not really giving you a high balance. But they'll be ready to give you a credit card that can charge you 30-something% interest. That's why it becomes a difference. Like, are you using the credit wisely? Because even if you have your money in some sort of savings, passbook, money market account, whatever, and you're getting like 4% interest, okay, that's great. The money's growing. But if you're using credit at a 28 or 30% clip, there's already an imbalance there. That means unless you have an asset, you're going to fall behind. Number 2, policy trade-offs. What trade-offs arise when central banks balance inflation control against employment and growth? That's why they keep always looking at, what is the labor rate, how many people are unemployed. That also influences the economic spectrum as well. If there's more people unemployed, that means you got to it's going to be harder for you to get access to credit because there's too many people that's not working. That means there's a big imbalance that's going on. It's not good for the economy. To lower the unemployment rate, that means people are pretty much working, and that means if they have stuff on credit, they have the ability to pay for it, which also helps the system to keep rolling. There's always certain things that you can start to look as benchmarks to look at it from a long-term view. Independence versus accountability. Should central banks be fully independent from government, or is some political accountability appropriate? Well, here, the United States government, the president can pick the governors or have an influence over that, but technically, the Federal Reserve is its own entity. It's a private corporation that's working in balance with our U.S. government, which is also a corporation. But we'll get into that in different other conversations because then people start to wonder, do we live in a country or do we live in a corporation? So that can be something for another day. The moral hazard. How might the lender of last resort role create moral hazard, and how can it be managed? Well, the moral hazard can be dependent upon a whole bunch of different circumstances. Maybe someone who works for the Fed know that this bank was acting a little crazy, and now they're going in and maybe they attempting to jump into some pennies on the dollar, and then somehow someone makes a boatload of money. That can be a moral hazard. That can be a space like, wait a minute, okay, how did this happen? Let's do the investigation. Let's figure out why did this happen and how did we get here? And the future of central banking, as digital currencies and fintech evolve, how might the role of central banks need to adapt? And that's what we definitely dealt with last week when we started dealing with about digital currencies and CBDCs, which is central bank digital currencies. And in that realm of possibility, we're starting to see that with technology keeps evolving, central bank is going to evolve. We talked about it, and we're already at the point with digital chips and financial institutions that are not necessarily banks, but they're financial institutions. You have the Venmos and the Cash Apps and the Chimes and all this other stuff that's going on that are now part of the diaspora, and the PayPals that are part of the diaspora. And these are not necessarily banks, but they're financial institutions. So with that being said, I believe I am complete. You know what I just did? No, let's take that off. Let's X out of that. Yes. And I am complete. I know it was a little longer than usual, but was very stimulated initially about the different things that can affect our finances as a community, not only here in the United States, but globally. Because when all that stuff hits with the tariffs, everyone's raising their prices. And the prices just doesn't affect us here in the US. It becomes a global ripple effect. And having at least a basis point or a conversation about how certain things is handled in regards to how our financial system works gives us a greater opportunity to recognize there's nothing wrong with credit. Credit is meant to be utilized wisely, not haphazardly, not crazily, not in foolishness or skullduggery. So having access to credit, or if you have those abilities that you can extend something, just use wisdom. Because I'd rather you see that you tapped into your credit resources because you're getting an asset. If you're getting an asset, then you're doing something, because at least you're going to get a return that can help you service the debt. Instead of just sitting there saying, oh, I use this credit because I like that jacket in the window. Okay, how's that jacket going to benefit you in the long term? It's not. That's the same way how the central bank plays the stopgap or the lender of last resort with the banks in our respective country. So any thoughts, any takeaways before we start to bring this to a close for this evening? Any takeaways, any thoughts, anything coming to mind?
I have a quick question.
Go ahead.
With the crisis backstop, we did a exchange with Japan and the yen. So basically, we gave Japan money and they bought additional US bonds. Is that from the central bank or is that from another agency?
Well, ultimately, when they're buying out bonds, those bonds are guaranteed based upon the fact that now, like when we used to have savings bonds back in the day, that you would buy $100 savings bond, and it would cost you $50. And then up to that maturity date, you would get interest until that bond becomes fully mature. Once that bond matures, now you can take that piece of paper and go back to the U.S. government. Says here, this $100 bond, when I lent you $50, is now matured. It has grown up. Now I'm here to get my $100. So buying the bonds, and that's why they said like how we owe a lot of money. You have nations who have bought our bonds, say at $1 at one price point, and it matures and they make their interest and things of that nature, and they're doing trade and you're doing all those nice little things and we're all kiki and ha until the point of the matter that bond matures and says, wait a minute, now you have to pay this thing. Are we going to refinance this bond? Are we going to do something else? Okay, you owe me $100. Okay, what I'll do is, okay, you'll give me $25, And now it should be another bond at $75. And now I'll wait some time because you're going to be paying me interest. And it's just a money game. Hopefully that explains it.
Yep, it does.
Amen. So, with that being said, because I know it's been a long evening, let me share the ways that we can support the platform. Because it was a lot tonight. I know it was a lot. It was a lot. I'll be the first one to admit to it. It was a lot. But we've seen a lot of craziness that's happening, that's influencing a lot of, just too much. Too much. So, but we would love for you to support this respected platform and becoming a member of the Comeback Collective Circle. Definitely become a subscriber to the YouTube channel at Dr. Gregory Clarke Master Coach. That's the handle. Or if you go into the YouTube search bar and just type in my name, Gregory Clarke with an E, D-Min, you should be able to see the channel populate up, become a subscriber, turn your notifications on. So when we are populating and sharing certain things, you will be in the know. But if you desire to support us and as we continue to market and promote this platform, you can do it via Cash App at $ Gregory Clarke D Min, or you can choose to do it via Venmo at Gregory Clarke D Min. So just drop the $, but the same handle on Venmo. And if you desire to do it via Zelle or PayPal, it's the same one email address, and that is esquire971@gmail.com. With that being said, continue to keep your head up, continue to be elevated, continue to grow and be inspired, and continue blessings upon your pathway. And can't wait to see all of you next week when we'll be in the month of September. Yay. Have a great week.
Good night, everyone.
Good night. How are you doing? This is Dr. Gregory Clarke, and I hope you enjoyed this past video. Now, once again, I invite you to become a part of the Comeback Collective Circle on this wonderful time frame, and not only by enjoying the video, but going to get my book, Life in the Huddle. You can get this copy and get your copy today, right now, by going to the Amazon.com website and type in Life in the Huddle. This is a great book, not only for yourself, but it's a very autobiographical tome that I've written. And the reason why it's so important, you can connect with the Comeback Collective Circle. You can support this community by financial means. You can do it via Cash App at $ Gregory Clarke D Min, or you can go by Venmo to Gregory Clarke D Min. Or if you desire to do it via Zelle or PayPal, you can simply use the same email address, esquire971@gmail.com. I hope you enjoyed the journey. Can't wait for you to see you as a part of the circle as we grow the community. Have a great day.